First, I want to explain what a budget is. It's a formal statement of a company's plans expressed in monetary terms. We're using past information to plan for the future. Let's do a little introduction to budgeting by reviewing some of the benefits. Budgeting assists management with its five basic functions. The first management function is control. Budgeting helps managers with its control function by providing benchmarks for evaluating performance. We're evaluating operations against the norm. This helps in identifying problems and taking corrective actions if needed. Budgeting assists management in its planning function by focusing on future opportunities and even on future threats. This helps management stay focused on the future instead of focusing just on the day to day operations. The third management function is coordination. This helps coordinate activities so that all employees understand and work towards the company's overall goals. The next management function is communication. This helps management to communicate their specific action plans and goals to all of the employees. You can't have a plan without communicating it to others. The last management function is motivation. Budgeting should provide attainable and exceedable goals for its employees. We'll discuss the motivational function more next. There are positives and negatives to budgeting. Budgets can be positive if the affected employees are consulted. Also, if the goals are challenging, but also attainable. Goals should challenge employees to work hard and to sell the products. When the goals are too difficult to reach, then it can cause negative behavior. Budgets should be analyzed carefully. Whether the company is over or under budget, those reasons should be explored. Why were we over budget? Which departments overspent and why? Do we need to increase their budget? Or was it a one time thing? If the company was under budget, why? Should the budget be allocated to other projects instead? Analyzing the budget reports really helps to ensure that each department is using exactly what they need. Budgets can also be negative when they're not implemented or communicated properly. As we just discussed, when a department is under budget, their funding may be reallocated in future years. Some managers or departments may avoid this by purchasing unnecessary items. Another negative really comes from unattainable sales goals. Pressure to meet goals can cause unethical behavior and even fraud. This behavior can increase if an employee will be fired if the goal is not met, or it will significantly decrease their paycheck. For example, those that work on commission or get extremely large bonuses. If you are dependent on the money, then an employee might do anything possible to reach that goal in order to pay their bills. Employees or managers who are consulted on their goals may understate sales and overstate expenses to allow for a cushion. For example, if a manager thinks they can sell 200 printers per month at their store, they might say they can sell only 150 printers. This way, when or if they sell those 200, it looks like they have exceeded their goal, which can lead to bonuses. Budgeting is a part of managerial accounting, which means it's for internal use only, and there are no specific laws or rules to follow. Budgets can be prepared for any time period. The most common is a 1 year time period with monthly and quarterly reports to supplement it. You want the period to be long enough to provide an attainable goal and minimize any seasonal fluctuations. Some businesses are busier during certain parts of the year. You also want the reporting period to be short enough to provide reliable estimates. For example, if you were preparing a 1 year budget versus a 10-year budget, the 1 year budget would be more accurate. The further into the future you go, the more unreliable the projections would be. Many companies use continuous budgeting. This is also called a rolling budget. This is when they add a new month to the end of the budget every time a month is completed. This way, the company always has a 1 year forward budget. Our next topic is preparing budgets. The master budget is a combination of all the budgets together. The different types of budgets are the operating, investing, and cash budgets. Once all the budgets are prepared, you can make the budgeted financial statements. We will be going through each budget individually, but I want to give you a layout on how they are all connected. Note, this is the master budget for a manufacturing company. Other businesses may not use all these budgets or will use a variation. First are the operational budgets. We always begin with the sales budget because that will dictate the necessary spending for the other budgets. Once we know how many units we plan on selling, we can determine how many units to make. Once we know how many units to make, we can calculate how much we will spend on materials, labor, and overhead. Once a production budget is complete, the capital expenditures budget can be prepared along with the selling and administrative budgets. After all these budgets are prepared, the cash budget along with its schedules can be done. The final step is to use these budgets to prepare the budgeted financial statements. We will be discussing each of these budgets next.